So moving along then to our first keynote presentation of the night, we're very fortunate to have Tony Pialis, who is the CEO and founder of Alphawave. And if you are not in the circuit design world, you might not be familiar with Alphawave, but it is a huge success story that I think a lot of people in Toronto should be aware of. So we're very happy to have Tony here tonight to be able to tell us more about what kind of the journey of Alphawave from uh, its origins as a Toronto startup company into something that's grown into a massive global corporation. So, Tony, I've just made you a panelist. You should be able to unmute yourself, and I'm going to make you a presenter now.
Perfect. Thank you, Dustin. Great to be here this evening with everyone. I am just sharing my screen, so let me know
Yes, we see it.
uh, when you folks can see it. Wonderful. So it's great to be here. The topic of my discussion tonight, and I'll try to keep it on schedule, is how to enable entrepreneurship in technology. Look, as passionate as I am about semiconductors, probably the only thing I'm more passionate about is entrepreneurship. And I'm a big believer in fostering innovation, enabling the next generation of technologists to build and develop wonderful technology and wonderful businesses. And I love to see that happen locally, within Canada, within Ontario, within Toronto, when possible. So, oops, what happened here? Sorry, my screen just jumped. All right. Uh, Quick introduction myself. Dustin already introduced me as the CEO of Alphawave. I've been in semiconductors for over 25 years, having founded, co-founded, led two previous companies prior. I've been a vice president of Intel. One of my former startups is now Intel Canada. So it's become the headquarters of Intel in Canada. So with the background of having been involved in three startups, two of them having been sold to U.S. Acquirers, one of them having been gone public within the last 6 months. Uh, you know, this topic of fostering and growing technology innovation is very near and dear to me. So first off, why become an entrepreneur, right? Most of us are used to graduating from university and getting a job somewhere. Well, look, if you're like me and you like to have control of what you do, what your work is, uh, control of your decisions, there's definitely a benefit to starting your own business. If you don't like taking orders from someone, I didn't like taking orders from my parents growing up, so perhaps that biased me to becoming my own boss. Also, uh, if you want to have the ultimate benefit of your own hard work, right, rather than someone else uh, taking claim for your hard work, when you own your own business, you benefit from its success and you suffer from its failures. Uh, Also, if you like doing different types of work. So some of us just like sitting in front of a monitor all day and running our simulations or writing our code, and that's wonderful. That's great. We need really gifted people to do that. But also, if you like a diversity of work, whether it's doing some technical, some legal, some business, some finance, some operations, there's no better way to achieve that diversity than with your own businesses. Now, there with all the upsides and positives, there's also challenges. Within a larger company, alignment is needed. Alignment is a term that's used frequently. It's building consensus in order to help drive decision making. You also are accountable to your boss, your customers, your employees, your board of directors, your partners. Uh, you must also, many times decisions are not made on what is best for the company or what's best for the product. Many times it's made for what's best for the shareholders. And certainly that sometimes leads to short-sightedness in terms of decision making. And also within a big company or a larger company, domain expertise is required, which means we're in a small company, you get to do many diverse things. In a larger company, domains are built and tasks tend to be more siloed. So you have business units, engineering teams, legal teams, finance teams. It's very hard to cross those boundaries. So this slide is my own description of a life cycle of any modern day tech startup. It always starts with an idea. That's the foundational innovation. For most, that's where it ends. But for a select few, there's a decision to act, to do something on that idea. Normally, some sort of seed investment is needed. Could involve angel investors. It could be founder funded, so the founders put their own money into it. But that is needed to launch the company, sometimes to get to a working prototype. Then there is a initial round of investment. If you go down the traditional venture capital path, that's the A round. With that, that generates enough money typically to get to sometimes prototypes, sometimes to production level parts. Then there's the task. You're now capitalized. You need to build a team. You need to take that idea and productize it, turning it into something that can be sold. Uh, Now you have working prototypes, maybe your first product launched. Subsequent investment rounds are needed to scale, to bring more products to the market, to ramp into high volume. Uh, then eventually design wins follow. So you're shipping products, you're winning designs, you have to scale your corporation in order to meet the growth that's been happening. You know, success feeds off of itself. So the more designs you win, the more you have to scale in order to meet those designs. Eventually, if you're able to sustain this growth, you get to a level that you can take the company public, and that really becomes the launching point of the next chapter of the company, where you're no longer a startup, right? You're now a publicly traded, could be a small mid-cap company that is competing with the biggest in the world. So I'm quickly going to skip through the different phases of this journey, and I'll talk and touch on what I think are the most compelling portions. Inspiration. This is uh, all of us, I'm sure, have had a moment in our jobs, in our spare times, when we thought we had a eureka moment, right? Uh, there was a gap that we've identified that we said, hey, that would be a great product to focus on. Well, having that inspiration is one thing, but having something that you can build a company around, what does it require? Well, first off, if you're going to try to solve a problem, uh, you need to have a credibility. So you need to be an expert in the space. Uh, Sales is all about trust. People need to be able to trust you to buy something from you. And in order to have that trust, you need to be able to earn that via your credibility. Secondly, business is all about momentum, and you can partially build that momentum, but many times the momentum is generated from the sector that you're focused on. Like right now, crypto, AI are all hot growing spaces. So ideally, your inspiration is in a fast growing, innovative area that is constantly fostering new developments, new investments. Also, these days, with geopolitics being what they are, you also should start to think about what area of the world do you want to focus on. And finally, uh, many of us come out of university ready to go to work or ready to start our own business. You know, I think the Bill Gates of the world that are able to start their Microsofts coming out of college or not even completing college is far Far and few between. So, my suggestion is establish that credibility, go work in the workplace, understand the problem and the pain points, and then that becomes the best launching point for you to start your own business. Initial action, what does this involve? It involves making sure that for that inspiration, that idea that you have a leadership team around you. That's a group of partners. That's a group of early senior employees that can help bring you lead customers, a network for building the team, building the initial engineering capability, the initial marketing needed to be able to launch a business, making sure that you have partners because you can't do everything yourself. Also, uh, you know, understanding the cost profile needed to get to a prototype. In any business, that getting to a prototype is a key milestone. And to do that, you typically need investment. So understanding your ability to be able to get access to angel investors or venture capitals, if you don't have the wherewithal to fund it yourself. So now, you have a group of partners around you. You have that great seed idea. Now you need some investment to begin to launch the company. Uh, Understand that if you go to investors without a prototype, with a idea and a set of PowerPoint slides, which is what most founders of businesses do, right? Normally it's inspiration and PowerPoint. Typically, that will result in loss of control of your company. Unless you have a track record of building successful multi-billion-dollar businesses, VCs, angels will typically look to take more than 50% of the company. So, the ideal development strategy for any business is try to get to a prototype without needing any form of VC or angel investment. Okay, whether it's self-funded, whether you can get some early potential customers to put some money in, or whether government programs like SR&ED, and there's multiple other Ontario and Canadian-based government programs that can be lucrative to help you out in early stages. Now, after that initial seed funding, assuming that you're able to go off and build a prototype, you now need what's typically called an A round to go and truly launch your business. And that allows you to bring in teams of engineers to help drive and build that initial product. Uh, and look, this is normally an exciting moment. If someone trusts you with 10, 20, $50 million for an A round, it's after sometimes toiling, 1 to 2 years to get to this and scraping by and living off of your life savings. This is a massive, massive milestone. But understand, nothing is for free. Venture capital typically looks to make a 5 to 10x return on their investment, especially on earlier rounds. So if they invest $20 million into your company, they're looking to pull out 200 million. And so if they own 50% of your company, that means a target valuation of no less than 400 million. So you got to make sure your idea can scale that type of valuation and can support that type of valuation. Even though, taking on that initial 20 million, is what you need to make sure that you can deliver the returns that's expected for you. And many times, and unfortunately, most times with startups, that doesn't happen. That normally results in founding CEOs getting replaced. Uh, and that is the most common path when you go down a traditional VC route, especially in the tech industry, especially in the semiconductor industry, which is so capital intensive for startups. But let's assume you make it through it. You're one of the lucky few that are able to get through it. Uh, and now you're in the team building and product development phase. First off, look, we all make mistakes. Everybody makes mistakes. Businesses make mistakes, but you can't make mistakes on your first product early in your business. So what does that mean? It means as you're scaling your business, the thing you need to be most cognizant of is risk. Okay, risk compounds. Risk doesn't add. So that means building a new product with a new team, risk multiplies. So how do you reduce it? Well, if you're going to go into your own business, make sure that you have a team of leaders that you've worked with, you have deep relationship and trust with. The term I commonly use is you've been in the trenches with. And that is how you can mitigate the risk. Even if you're going into an aggressive new technology, doing that with a proven team is invaluable. Most VCs will require this. They will not even consider making an investment into your product unless you have that proven leadership team that you can bring to the table. Now, let's assume you've assembled the team and you are launching that first product and you're securing later investment. Well, profitability is key. All right, breaking even is another major milestone in the journey of any business. And as a founder, as an entrepreneur, as a business person, your goal from day one should be to get to profitability as quickly as you can. Because once you get to profitability, that's how you stop conceding control of your company to investors. At that point, raising money to be able to scale your business comes at a significantly lower cost because you have been able to build a profitable business. So that means as you look at your business plan, the ideal product could take 5 years and $100 million. But if you can get to profitability, albeit at a smaller revenue with an earlier product, that is almost always the right decision. It gives you infinite credibility to investors and even to customers. So sometimes that first product works. Other times it may not fully deliver in terms of all the feature set that you envision. The market around you may have shifted. The window for that technology may have shifted. You may have been too early. You may have been too late. It happens many, many times. There's public companies like Infi who initially came and raised multiple rounds on an initial product, and that market never materialized. And they had to go and rebuild a new business plan and retriangulate and retool their business and go into a new sector. It happens a lot in new technology. So doesn't mean the company goes bankrupt. It just means you need more investment rounds, which means more dilution. So the venture capital investors in the company take on a bigger stake. Founders typically get wiped out, which means you go from having a significant amount of ownership to potentially a much smaller piece. And many times it involves leadership churn and change. Uh, it happens, and if it's happened to you, don't be discouraged. Keep at it. It's very rare that the first idea ends up being, that multi-billion-dollar inspiration. So let's assume you've made it through productization. You now have a tangible product. Uh, Sales is the lifeblood of all companies. All right, we're all technologists. Everyone on this call, we're all engineers. We love technology. Many times, engineers ascribe more value into the technology that they develop, that they invest their blood, sweat, and tears into than the market. And that's a risk when you have engineering-based leadership. Uh, at the end of the day, sales is the lifeblood of all companies. Why? Because you can't do anything without cash, and sales brings the cash into the company. As much as we love tech, if we're not paid enough to do it, we'll all have to go find other jobs. So make sure that sales and profitability and marketing are valued in day one. I've seen many tech companies that have been founded by engineers that didn't invest in this space, and even though they had great technology, it was sold for pennies on the dollar in terms of investment because they couldn't sell it, or it wasn't well suited for the market because they didn't go talk to the customers early on. It was internally built, internally driven. So embrace sales, embrace the value of sales, embrace the feedback of customers. Trust, listen to what your customers are saying and use it to calibrate. But this is key, right? You cannot scale unless you win in the market. And to win in the market, you need to have a successful, not only single product, but portfolio of products. So let's assume now you've accumulated sales. You've had multiple design wins. It's now time to take that revenue that you've earned, that profitability that you've achieved, and invest it back into your company. And that is what this is about. It's about scaling the corporation. And so now you go from a relatively flat company where you have maybe a small group of founders and tens of people working for them, maybe up to 100 people, to now scaling to 1, 2, 300, 400,000, several thousand person company. And this is now where the startup evolves into a more mature corporation. You have directors for the corporation. The board of directors becomes much more mature. VCs get replaced with more institutional investors. You end up adding on CFOs and COOs and introducing a layer of vice presidents into the company. And normally when a company gets to this point, that originally founding CEO has moved on. He might still be on the board. He might have left the company completely. And so you could be on your second or third CEO at this point in the life cycle of a business. So now let's assume the company's continued to scale. You've had multiple quarters of consecutive growth. The company now is at a point where if it could raise more capital and a significant amount of capital, it could use it to accelerate on future growth. And typically there's two paths. One is private investment placements, or the other is a public offering. And many times an IPO is a faster path to generating capital than through private investment. And there's also the credibility that being a public company establishes, a credibility to customers that drives most businesses into the IPO path. So if your business is growing quickly, if you can generate multiple quarters of continuous growth, if you're able to get up to at least 50 million, ideally over 100 million of revenue over your trailing fiscal year. Now with SPACs, that's not the case, but let's talk about more Canadian IPOs. If you can get at least a 50 million in revenue over the trailing year, and if you're profitable, which means your EBITs, your earnings before interest and taxes, are relatively high, I mean, you're an ideal target to go public. Okay, there's tons of investment banks that would be willing to work with you to try to take you public. And now in the US, even if you're not generating any revenue, you can still go public through new vehicles such as SPACs. And look, we just went through it at Alphawave in May. It's a major accomplishment. It's certainly a highlight for me in my career. But look, nothing comes for free. You're now in the capital markets. You have new investors you need to please. And you have quarterly targets or semi-annual targets that you need to deliver to. So that growth that you've leveraged to go public is now expected of you via the market. So look, running a business, growing a business, it's challenging, it's rewarding, it has pressure, it has the highest of rewards, it can completely change your life in ways that you could have never imagined, well beyond financially. But ultimately, the key to being successful is relationships. And so my advice to anyone that I work with, anyone that's part of my team, anyone that I've mentored over my career, the one common theme has been relationships. Cultivate them early on in your career. You can leverage them to form that initial team to start the business. Those relationships that you establish early on can result in key customers for your business. You leverage them to grow your team, to bring on advisors, boards of directors, new executives to your company, and ultimately those relationships, those human interactions, that's what establishes trust. And so trust is ultimately a priceless commodity in business. Okay, it's a key commodity in business. And so when you promise something, make sure you deliver on it. And if you do, good things will happen to you in your career, whether you end up taking the entrepreneurial route or whether you end up working in a company somewhere else. It's by far the best strategy to help grow your success. And with that, I thank you for your time this evening.
Thanks very much, Tony. That was great. So I guess if anyone has questions, feel free to post them in the Q&A if you can figure out how to do so, or to send a chat message to me and I can relay them. I guess while we wait for any of those to come in, a question from me, Tony, um, about the process of going public and investor funding and things like that, and your opinion on how that relates to the cyclical nature of the markets and the ups and downs with investor funding, and are there times when investors are more eager to spend the money and willing to throw money at whatever comes their way, and other times when they're tighter with their wallets? And do you take that into account, or do you care at all as someone developing a technology company?
No, it's hugely important. Look, there's that herd mentality that's extremely valuable. Most investors are generalists. They don't understand technology. And so, especially in our area of semiconductors, this is extremely foreign to them. Okay, you would not believe how I've had to simplify the technology that we develop in order to have them identify with it. So, what do they identify with though? Hey, AI is hot. Look at all this money that AI companies are making either through their investment rounds and their valuations or from companies IPOing. And so if you're able to target a fast growing, highly regarded, heavily invested into industry, these generalist investors, that simplifies the decision making for them. Okay, and so it's easier for them to go back to their PMs and justify an investment if it's a hot growing area than in an area that no one's made money in for the last 10 years. And for us in semiconductors, I'd say up to maybe 2, 3 years ago, yeah, no one was making money off of semiconductor startups. But over the last 2, 3 years, and certainly with the semiconductor shortage, it's really brought the value of we semiconductor designers to the general population, right? If you're buying a car, if you're trying to get a hold of semiconductors to go even into the most mundane of devices, it's extremely hard. So you have governments investing money, you have general press talking about it, and that has reinvigorated our industry from an overall investment perspective.
Okay, thanks very much. A question in the chat from Sadeg, which I think is a good and relevant one. It's a question about the how you see the future of this of semiconductor technology in Canada, and from what your experience has been. I mean, you've started up multiple companies now, and there seems to be a tendency that when a semiconductor or a lot of technology companies in Canada start up and seem to be achieving success, a large corporation from the US or maybe increasingly from other countries might swoop in and scoop that company up before it has a chance to go public and remain a Canadian corporation. What's your opinion on that, and what advice do you have for people starting up their companies?
So Uh, it's a great comment. I've unfortunately, in two of my previous businesses, fed that cycle of selling to US acquirers. Not this time around. This time we retain control. Look, it's challenging because once you build value, you immediately become a target. And in our industry, it's hard to scale. It's possible, but it's difficult. And so many times, success attracts interest. And look, the biggest semiconductor companies in the world are American, and that's why you typically see US acquisitions of Canadian semis. So how do we stop that? We should uh, a- a- we should try to encourage our government to help foster continued growth and investment in semiconductor, but we should not rely on government. Okay, I every opportunity I try to help prioritize the value of semiconductors to our Canadian government through multiple channels. But at the end of the day, it's up to us, us technologists, us entrepreneurs, to have some national pride and to have a dream of a scale of not just getting to profitability or selling to an American acquirer, but really do something substantive in this industry. And so if we have and can foster those types of visionaries, okay, to get to that scale and maintain that nationalistic pride, I mean, that's what we need to do. How did the US get to its level? It didn't rely on government. It had visionaries in its semiconductor industry that achieved this scale on their own. And that has built an ecosystem around them, and we need to do the same. So we need to focus on where we can achieve the most success and drive innovation, and hopefully we can have those visionaries that want to achieve that scale and keep it Canadian.
Okay, yeah, that's great. Thanks very much. And then I guess a follow-up question to that from Mengshi. So what is the financial risk that you take then by, if you are a visionary and you've created a Canadian company and you believe in it strongly and you have a US company knocking at your door saying, hey, I'm willing to make you rich right now if you sell it to me. Um, and so obviously there's a risk there. And is there anything you can do to offset that in the long run, either through politics or outside of politics or what's your advice on that?
Yeah, so look, the US, what's happening now more and more, the US has it, the UK is installing it in January, Germany has it, is a regulatory body, okay? A regulatory body that reviews and has to sign off on any foreign investment or acquisition of critical technologies. And so, we are changing geopolitically from a time of global free trade to now more protectionism. And certainly, as there's constraints in our supply chains, nations are becoming more critical of owning supply chains for critical technologies. And so you have governments getting more and more involved. And so that is one avenue that multiple countries are using to try to maintain more ownership of technology that they view as critical, and obviously semiconductors being one of them. Canada does not have anything like this currently. If you ask me whether I think this is a good thing or a bad thing, look, as a capitalist, as an entrepreneur, these types of government regulations, I personally think are bad. They stop innovation rather than foster innovation. Okay, I think they're means that politicians use in order to please their electorate rather than fuel more investment. I think the more global trade we have, the better off we are, because he who has the best idea wins, not just he who's local wins. Uh, but look, it's a tough challenge. At the end of the day, I think we have the know-how, we have the capability. We just need the same entrepreneurial spirit that Silicon Valley had, in the 50s, 60s, and 70s that built giants like Intel, Qualcomm, Broadcom. If we can cultivate and keep within Canada those visionaries rather than have them leave, that I think is the best path to maintaining technology independence.
Okay, yeah, thank you very much, Tony. It was a really interesting presentation. I think I know you've got to run for you've got a little man in the house that needs to get to hockey. So if there are any further questions, please anyone feel free to email me and I can connect you with Tony offline and you can continue the discussion. Thank you again for being here.
Thanks, Dustin. Thanks, everyone.